Welcome. Just We are discussing one chapters accounting for merchandising operations. We are following this book, Accounting Principle, Weygandt, Kimmel, Kieso. And now, learning objective 7, appendix 5b, record purchase and sales under a periodic inventory system. Earlier, we have discussed more regarding perpetual inventory system, now periodical inventory system, and finally, we will show what is the difference between periodical and perpetual inventory systems. Determining cost of goods sold under periodic system. So, running accounts of charges in inventory, and second, ending inventory determined by physical count. After physical counting, just we can determine the ending inventory, and cost of goods sold not determined until the end of the period. That means end of the period we consider cost of goods sold. I think everybody is clear this step, determining cost of goods sold under periodical system. Cost of goods sold January 1 36,000, and here purchase this figure, $3,25,000, less purchase returns and allowance, this figure $10,400, and purchase discount. After adding these two figures, we are getting this figure. Net purchase, this figure, less this figure. So $3,07,800, and add freight in $12,200. So cost of goods purchased, this figure. So after adding these two figure, aggregately we are getting cost of goods available for sale. But end of the year we have found that ending inventory 40,000. So the cost of goods sold, after subtracting 40,000, we are getting 3,60,000. This is the cost of goods sold. Recording merchandise transaction, record revenues when sales are made. Okay, do not record cost merchandise sold on the date of sales. A physical inventory count determines cost of merchandise on hand and cost of merchandise sold during the period. Okay, record purchase in purchase account. Purchase returns, allowance, purchase discount, freight cost are recorded in separate accounts. Okay, this is very much clear to everybody, I think. Now illustrations on the basis of the sales invoice, illustration 5.6, and receipt of the merchandise order from PW audio supply, swag stereo records $3,800 purchase as follows: purchase debit, accounts payable credit. Okay, now freight cost 150. That's 150 is how the purchaser, how could he show this matter. The freight in debit or cash credit. Now purchase return and allowance. So accounts payable and purchase return and allowance. And now purchase discount, the 2% discount, already we have discussed is your perpetual inventory system. Now under the periodical inventory system, just I have shown it just very slightly. So 2% discount within 10 days. So here accounts payable, purchase discount and cash. Just we are paying cash, that means the purchaser or buyer is paying cash. Our account payable full 3,500 and purchase discount 70 taka. And this is the 3,800 of merchandise purchase. Record sales PW audio supply company. That means this is a seller company. Accounts receivable or sales revenue. No entry is recorded. Cost of goods sold at the time of sale under the periodical system. No entry is required here. Now sales returns and allowance. Sales returns and allowance, PW audio supply records 300 sales return allowance and accounts receivable. And sales discounts, the very much easy: cash, sales discount and account receivable. So comparison of entries: perpetual inventory and periodical inventory. So purchase inventory debit or purchase debit. Freight cost inventory freight in debit. Here purchase returns and allowance, inventory credit, purchase returns and allowance credit. The payments on cash, inventory credit or purchase discount credit. This is the difference between perpetual and periodical inventory system. And this is the PW audio supplies books. Earlier slide we have shown, and this is the SOG stereo books. This is the purchaser book or buyer book, and this is the seller book. Seller cost of goods sold, here no entry. Here inventory, cost of goods sold, no entry. And all are same here, no problem. And this is the worksheet. Just here, this is the opening inventory, this is the closing inventory, and sales revenue. Okay, sales return allowance. Just this is this red color related to the merchandise inventory. That will accounting for merchandise operation related. So we have discussed earlier, and now we are discussing this matter. I think everybody is clear this matter. That means 2000 prepaid insurance, and this is the insurance expense 2000. This is credit and this is debit, and rest amount 1800 prepaid insurance. That means we will get more benefits from this figure. Okay. So in our all videos we have discussed more regarding this worksheet. Okay, this is the final. It's all together. Thank you so much for watching this video.